Dividend stocks aren't what most people think they are, and that's exactly why so many investors fall into what experts quietly call the dividend trap. Imagine building your entire financial future around something that looks safe, steady, and comforting, only to realize years later that the thing you trusted most was slowly draining your wealth instead of growing it. That's the story we're diving into today, and by the end, you'll look at dividend stocks in a completely different way. Before we begin, I want you to picture something. You're scrolling through your brokerage app. You see a stock with a 7% dividend yield. 7%. Wow, you think. That's free money. That's passive income. That's the dream. You imagine yearly checks just for owning the stock. It feels easy. It feels safe. It feels like the stock market is finally paying you back. But what if that 7% isn't a gift, but a warning? What if the high dividend is there not because the company is generous, but because the company is in trouble? What if the dividend, your supposed guaranteed income, is the very thing that blinds you from seeing the real danger? And what if millions of investors fall for this every year? Stay with me, because this story might save you from losing years of wealth-building potential. Let's start with the truth that no one tells you when you first start investing. A dividend is not free money. It is simply the company handing you a piece of what you already own. If you own 100% of a business, and that business gives you a dividend, it's not creating new value out of thin air. It's taking money out of the business and giving it back to you. It's like moving cash from your left pocket to your right pocket and celebrating that you're richer. Some companies can do this sustainably. They make plenty of profit. Their business grows. Their customers keep buying. Their earnings rise year after year. For these companies, dividends are simply a way to share extra cash they don't need right away. Those companies are fine. They're the exceptions. They're the Coca-Colas, the Johnson & Johnsons, the companies that weather storms for decades. But many dividend seekers never buy these strong companies. Why? Because these reliable companies usually pay small yields, 2%, maybe 3%, sometimes even less. So new investors think, why should I take that small percentage when this other stock pays 6%, 8%, even 12%? And that is how the dividend trap begins. A high dividend yield looks attractive. It looks like the stock is rewarding you more. But dividend yield is calculated by taking the dividend payment and dividing it by the stock's price. So if the dividend stays the same, but the stock price falls, the yield goes up. Let that sink in. A high dividend yield often means the stock is falling, not rising. Imagine a company whose stock price drops from $50 to $25 because its business is weakening. If the company still pays a $2.50 dividend, the yield jumps from 5% to 10%. You might see the 10% and think, great deal, but seasoned investors see a distressed business. Here's the question. Would you rather own a company paying 10% while its stock collapses, or own a company paying 2% while its stock grows steadily every year? Think of it this way. A shrinking business can't save you with big dividends. The stock price eventually drops so much that the dividend becomes impossible to maintain. And when a company cuts its dividend, the stock often drops even further, wiping out years of free income in an instant. Have you ever owned a stock that cut its dividend? If so, how did you feel when the price dropped? Share your experience in the comments. Someone else might learn from it. Let's go deeper. There's a hidden psychology behind dividends. Many investors love dividend checks because they feel like income, something solid, something dependable. But this emotional comfort can make people blind to risk. A stock might be outdated. Its business might be shrinking. Its debt might be piling up. Its customers might be disappearing. Its revenue might be slowly weakening year after year. But as long as that dividend payment arrives, many investors refuse to look deeper. They say, the dividend is still coming, so everything must be fine. But sometimes, the dividend is the very last thing a company cuts because they know how much investors value it. They keep it alive until the very last minute, sometimes even borrowing money to pay it. Imagine borrowing money just to pretend everything is okay. Many companies do exactly that. This is why investors fall into the trap. Because dividends can create an illusion of stability even when danger is right around the corner. What's even more interesting is that some investors get so attached to dividends that they ignore the total return, which is what really matters. Total return equal the dividend income plus a stock price movement. What good is a 7% dividend if your stock price drops 20%? What good is a 10% dividend if the company collapses in 5 years? Now let me ask you a serious question. Would you rather receive a small dividend from a growing company or a big dividend from a shrinking company? Tell me your answer in the comments. There's no right or wrong, just different investing philosophies. Here's another secret many beginners don't know. Companies that pay high dividends usually aren't the ones growing fast. Why? Because high-growth companies reinvest their profits. They don't hand money out because they need that cash to expand, hire more workers, build better products, or enter new markets. A high dividend often means a company has stopped growing. It's old. It's stagnant. It's past its prime. There's nothing new to invest in, so it gives cash back to shareholders instead. Now, that's not always bad. Some mature companies still generate strong profits, but you must understand the trade-off. If a company is paying you a dividend, it's not putting that money back into the business. And if it's not putting money back into the business may not grow. No growth means a weaker stock price over time. Weaker stock price means lower total return. Lower total return means slower wealth building. Here's something that surprises many people. The investors who make the most money over time aren't the ones chasing dividends. They're the ones buying companies that grow and compound. Think about the biggest winners in the stock market over the last 20 years. Apple, Amazon, Google, Meta, Tesla. If you had asked any of these companies for a dividend, they would have laughed. They reinvested everything, and look how that turned out. Would you rather collect a tiny dividend from Amazon or watch it 10x in value? Think about your own financial goals for a moment. Are you investing for income right now or for long-term wealth? Tell me in the comments. I read all your answers. Now, let's look at the real danger of dividend traps. A company can pay too much. It can stretch itself thin. It can focus more on maintaining the dividend than maintaining the business. And when that happens, the decline is slow and quiet, until suddenly it isn't. Many investors have watched a stock fall from $40 to $30 to $20 to $10, all while saying, well, at least I'm still getting dividends. But here's the truth. If the stock drops 70%, the dividends you collected don't matter. The loss overwhelms the income. That's the trap. Now I want you to pause and really ask yourself this. Why do you invest in dividend stocks? Is it because you truly understand the business? Or is it because the dividend makes you feel like the stock is safe? Share your honest reason in the comments. Someone else might relate to your story. At this point in the video, if you're learning something new or if this is opening your eyes a bit, make sure to like, subscribe, and share this video so more people can avoid falling into the dividend trap. And trust me, we're just getting started. Let's talk about something else almost no one discusses: taxes. In many countries, dividend income is taxed differently from capital gains. Sometimes it's taxed more. Sometimes it hits your income tax bracket. So a high dividend might actually reduce your returns after taxes. Meanwhile, if your stock grows in value, you don't pay taxes until you sell. Some investors never sell at all, meaning they grow their wealth with minimal tax drag. Another twist in the story is inflation. If your stock pays a 4% dividend, but the stock price never rises, you're losing purchasing power every year. Dividend lovers often ignore inflation, but it's always there, silently shrinking your real returns. Let's pause and reflect. What's more important to you as an investor? A steady income stream or long-term growth that beats inflation? Drop your answer in the comments. I'm curious to see how people think about this. Now, this doesn't mean dividend investing is bad, not at all. There are great dividend companies. There are great dividend strategies. There are even great dividend ETFs. Dividends can be part of a healthy portfolio. But they shouldn't blind you. They shouldn't trick you. And they definitely shouldn't be the only thing you look at. If you want to avoid the dividend trap, here are the real questions you should ask. Is the company growing? Is the dividend payout sustainable? Is the company drowning in debt? Has the dividend been rising slowly for years or struggling to stay alive? Is the business strong, or is the dividend the only attractive thing about it? Ask yourself this important question right now. Would you still buy the stock if it didn't pay a dividend at all? If the answer is no, you might already be in the dividend trap. And here's something else most people never think about. If a company pays out 80% or 90% of its profits as dividends, what happens if the economy slows down? What happens if earnings drop? What happens if interest rates rise? What happens if new competitors enter the market? The dividend becomes vulnerable. The company becomes fragile. And your investment becomes risky. Now ask yourself another question. Would you lend money to someone who spends almost everything they earn every month? Of course not. So why invest in a company that does the same? As we reach the later part of this video, I want you to think about your future. Are dividends part of your long-term plan? Are you chasing high yields without understanding the risks? Are you focusing more on income today than wealth tomorrow? Leave your thoughts in the comments. I truly want to hear what kind of investor you are. Dividend stocks can be powerful tools. They can create income. They can provide stability. They can reward patience. But only if you use them wisely. Only if you understand the dangers. Only if you look beyond the yield. When you see a high-yield stock, don't ask, how much will it pay me? Ask, why is the yield so high? When you see a company paying huge dividends, don't ask, how big is the check? Ask, is this sustainable? When you feel tempted by a giant percentage, don't say, it's free money. Say, what does the business look like underneath? Because in the end, wealth isn't built by chasing numbers that look big, but by understanding the numbers that actually matter. If you learned something new today, or if you feel more confident about avoiding dividend traps in the future, make sure you hit the like button, subscribe for more content like this, and share this video with someone who needs to hear it. Now tell me, before you go, what's one dividend stock you used to trust, but don't anymore? Or what's one stock you think might be a dividend trap right now? Drop your answer in the comments. Your experience might save someone else from falling into the trap.